So welcome to this week's City Speaker Home. It's a great pleasure to welcome a new speaker this year. So Paul Treue is with us this evening to share his almost 30 years of experience working across the hedge fund industry. I don't want to steal the thunder, but just looking at that line and how his fund has performed is definitely exciting, and hopefully he'll share some of his wonderful insights through various cycles with us this evening. So welcome, Paul, to this year.
Thank you. So just to start, I'm happy with questions at any point. You can interrupt me, because I assume if one of you guys, if I use, let's say, an American word or a trading lingo word and it doesn't make sense to one of you, I don't mind interruptions or questions at any point to go over these things. So, and my coworker Andrew Johnston is here with me as well. So we run the Barnegat Fund. And so here, when I was in your role, when I was in college, I always wanted to know, why should I listen to this person who's here today? So this is why I just start with, we've had a pretty good run. We've returned about 13% a year for 25 years. So you can see our share price, is that blue one. We've outperformed, the stocks, the bonds, the emerging markets, everything else. And so the thing I'm here to show today are various trading examples. And I figured since I'm in the UK, I'll talk about UK quantitative easing. Because the way that Barnegat makes money is the non-economic decisions of others. So one of the questions I get a lot is, why is anyone going to make a non-economic decision? And it happens much more than you would think. And one of the great examples is quantitative easing. So Bank of England, they're trying to get 2% inflation, and inflation was under-hitting prior to 2008, was not getting up to 2%. And they did not like that, and they wanted to turn on the printing presses to try and get interest rates down, spur the economy on, and get inflation back up to 2%. So that being a non-economic decision. So they were going to distort the bond market, and I'm going to go to that here next. So the whole point was, the economy is struggling in 2008, 2009. It's the global financial crisis. The economy is really having a tough time. They want to help the economy along. They want to bring interest rates down so businesses can can borrow at a low rate. And so they did two things that were strange. One of them was, they came out and said, we're going to buy gilts. We're going to turn on the printing press, we're going to buy gilts, and we're going to force interest rates down. And it was super effective. But they said there's two types of instruments that the UK issues. They issue gilts, which is a fixed interest rate, and they issue linkers. Linkers pay a fixed interest rate plus whatever inflation turns out to be. So you can trade inflation. So just to give you an example, let's say gilts are yielding 5% right now, linkers yield 2%, and inflation trades at 3%, so your linker has to yield the same as your gilt once you hedge out inflation. So here you can see historically, right along here, here's the scale, and here at 0, that's when linkers yield the same as gilts, right, at this point. So and you would expect linkers to yield the same as gilts once you hedge out inflation, because if it doesn't, people like Barnegat Fund come in and make money from that. So for years here, it's going along right, efficiently priced, and then the global financial crisis hits. And Lehman Brothers goes bust, and the Bank of England turns on the printing press. And they say, hey, we're just buying gilts, we're not buying linkers. And you can see up here, they initially said, we're going to buy, it was 150 million, here it is up here, 150 billion of the gilts. There were only 548 billion outstanding, so they're trying to buy 30% of the gilts that are outstanding. A lot of those gilts are locked away, and so let's say Cambridge University, they have an endowment, they buy gilts and they just own those gilts. They don't have any intention of selling those gilts. So the Bank of England has a problem. They're trying to buy 150 out of 548. That's a big percentage. Naturally, the yield on those gilts goes down. So here's what happens trading-wise. The gilts are efficiently priced. Now the gilt yields go down. The linker yields do not, because they're not being bought. The other thing too, remember 2008, 2009, the economy is in the tank. A lot of people are on unemployment. and the UK government has to spend a lot more money and therefore issue a lot more bonds because people are on unemployment, they need to support the economy, they need to support the population. So they're issuing as many bonds as they can. Bank of England is buying the gilts, and you can see that the mispricing just starts to get bigger and bigger. Here's the scale. Here's linkers yield, nearly 0.5% more. It gets all the way up to about linkers yielding 1.5% more than the gilts were. So that is right up Barnegat's alley. We go in, we buy the linker, we hedge out inflation, and we short the gilts. And just to be clear, on these relative value trades, when we buy a linker, we will repo that bond. So repo is like a mortgage. So when you go to buy a home, you go and you buy the home, and then you go to the bank and say, hey, I don't have all the money to buy this home. I need to borrow money from the bank. The bank says, sure, we'll lend you all you want, but you have to post that home as collateral with us. So you have to put a little bit of money down up front when you get a mortgage. In bond trading, you don't have to put much down. You buy the bond, you go in and you say, hey, I'd like to post this bond as collateral, and they will lend you the money to buy that bond. Same thing as when you short the gilt, you short that, you get the money in from the short, and then you have to deposit that back with the bank that you borrowed the bond from. So just to be clear, when you buy a bond and short a bond, and you repo both of them, there's no money up front. You just have this trade, and it's kind of like, let's say you and I last night, Tottenham plays Man United. You and I bet on Tottenham versus Man United. We don't exchange any money before the game, then the game occurs, and then we settle up. It's similar to that in the sense that there's no money up front, you put the trade on, and then you settle once the trade is completed. So we have a trade that comes zero on day one. We have to post collateral with the counterparty, but we have plenty of collateral sitting around. So we have to post collateral, and we're owning a bond that's yielding 1.5% more than the bond we're shorting. They have the same maturity. They're both issued by the UK government. The credit is the same. It's a identical situation, and this is how Barnegat makes its money. So one of the other things too that is, I guess, somewhat surprising to me all the time, you think, oh hey, 2 UK government bonds, same maturity, same issuer, same credit, same everything. You'd think as soon as they became mispriced, that would go away tomorrow, that the world's efficient, markets are efficient. For the most part, markets are efficient. But if you look here, this took 2 years for this to sort itself out. It starts to go haywire when Lehman went bankrupt. Lehman went bankrupt September 15 of 2008. And, it didn't sort itself out here until 2010. So these kind of things take a long time to sort themselves out, even if they're obvious, simple trades like this one, of just a linker against a gilt. So the other thing that happened here was the Bank of England tried to be clever. They tried to be clever. This is what their announcements were on what they were going to do on quantitative easing. So at the beginning, they said, hey, we're going to buy 150 billion pounds worth. There's only 548 billion in the market, so just under 30%. Now the part that they were trying to be clever on, they said, we're going to buy gilts that are longer than 5% and shorter than 25. Longer than 5 years, shorter than 25 years. I think their logic was, they have that central bank rate, which is the very short-term rate in the market, and they didn't want to mess that up. And then pension funds, their liability calculations are done off the 30-year bond. I think they didn't want to mess that up either. So they just said, hey, we're just going to do between 5 years and 25 years. And now the problem with that is people like Barnegat come in. So here, this is the yield curve after the Bank of England comes in. Now, just to be clear, this is the forward interest rate curve. So, normally when you look up in the newspaper, it'll say, 1-year interest rate, 2-year interest rate, 3-year interest rate. This is the overnight rate for every day for 30 years. So we're calculating, you can take the 1-year rate and you have the 2-year rate, and therefore you can calculate the 1 year starting in 1 year. This is even finer, so you could think of this as like 10,000 data points, as in 30 years, 365 days a year. So this is the prediction for every overnight data point from the bond market in the spring of 2009. And so the part that Bank of England, again, is buying from 5 years, they forced this yield very low, and they're buying up to 25-year. They're avoiding this stuff in the short end here, and they're avoiding this stuff in the long end. And so this distortion was fantastic for us. As in, you can see where we wrote, because remember at the same time, the UK government is trying to sell as many bonds as they can. They're super in debt from the global financial crisis. They just need to keep churning out those bonds every possible day they can. So yields are being forced up because there's all this issuance. But Bank of England, remember, they're trying to buy 30 to, in the end, it turned out to be like 60% was their high. 30 to 60% of the market they're trying to buy in. And the rule is that the Bank of England is not allowed to trade with the government. So the government has to issue the bonds into the market. Bank of England has to buy the bonds from the market. Like the clear answer is just the government sells to the Bank of England, but they're not allowed to do that. So you have this huge problem of government forcing yields up all the way across the curve because they're trying to sell anything they can. Bank of England is just buying from this 5-year point out to 25 years. So the trade we have on is we receive these high rates here. So it's basically out to 5 years, we're buying bonds, we're paying these low rates here that the government or the Bank of England is forcing lower, and then we're receiving these high rates here. So, and then one other note, you can see Bank of England, gets the short-term rate down very close to zero, because again, they're trying to spur the economy on, trying to get inflation back up to 2%. So the trade we have on is just receive, pay, receive, just a very simple butterfly. And one of the points here is, so let's say the curve steepens or flattens, we really don't care, because if it steepens and flattens, we have a simple 1-to-1 ratio, as in we're indifferent to steepening and flattening. We're just betting on the shape of that yield curve. And so one of the things that happened was we got into this trade, and I'm very excited about this trade. It's a fantastic trade. Same thing, this one back here, this is a fantastic trade. We put a lot on these positions. And oh, one other thing too, just one note, Milton Friedman, oh, go ahead.
Just one quick question. Can we go back to the previous graph? So this one, perfect, understand this makes sense to me. Can we move on to the next one? This one. So in the first graph, there's not going to be a maturity mismatch. But in this second one, if you're buying the shorter term forward and then receiving the longer term forward, you have the maturity risk, don't you, between the two instruments?
Yes. So, and just when you say, I'd like to say receive versus pay,
yeah,
because we do this through bonds. That's easier to say buy and sell, but we also do it through interest rate swaps, and those are a little more awkward. Are you buying the interest rate swap or something? So I always try and say receive and pay. But so yes, so we have risk here, and that is exactly what happened. So we put this trade on. I'm super excited about it. We have a lot of it on. And what happens is Bank of England, Milton Friedman says there's nothing as permanent as a temporary government program. And Friedman was right. So they started buying here, they start trying to buy 150 billion out of 548. By the time they were done, and that was 27% of gilts, by the time they were done, they bought 895 billion. There weren't even that many gilts out, there was only 548 outstanding at the time. So in the end, they bought 895 billion out of 1493. So on your question, we put this trade on, and so if the interest rates, let's say in the 3-year, go higher, we're going to lose. I'm answering your question. That's what you were asking, right? Yeah. So if interest rates go higher in the 3-year, we're going to lose because we agreed to receive, let's say that's 3.5%. If it goes to 4%, we lose. And same thing. Right here around 5 years, we agree to pay around 2%. And so what happened was Bank of England, first we put the trade on here on this very first QE1. Bank of England comes back and says, oh, now QE2. And so this graph gets even more pronounced, as in the places where we're receiving, those rates go higher, we lose money. The rates, since they've cranked up the buying, the rates where we're paying, those go even lower because Bank of England's buying even more. And so we lost money on this trade initially. And we do lose money, I'm going to say, pretty frequently initially. Of the things that Barnegat's bad at, we're not good at saying, oh, this is the moment to get in the trade. From now on, it's going to be great. We're not good at that. The thing that we're good at is just saying, hey, we're going to receive the high rate, pay the low rate, receive the high rate. Because, so what happens, Bank of England cranks it up, we lose money. But as time passes, so let's say 1 year passes, we agree to receive 3 years, this high yield. After a year, that year becomes a 2 year and is now a much lower yield. So that was one of the great attributes of this trade was we receive here, pay here, receive here. A year later, we had received at this interest rate, it's rolling down towards this trough. We agreed to pay here. A year later, so let's say this was a 5 year, a year later, that's a 4 year now. So where we paid low, now it's getting higher interest rates. If we received up here a year later, that's coming down here. So, a 3 year turns into a 2 year, turns into a 1 year, and as you can see, Bank of England had very low short-term rates. So here's one on that point of, the maturity risk we had. So here you can see, this was the yield difference just between a 4.5 year bond and a 5 year bond. Very similar bonds, but that's how crazy things were that remember this is an upward sloping yield curve. Obviously you have a big trough in there, but longer rates are higher than shorter rates. Just, the short stuff is very low and the long stuff is high. You have this weird trough in there. But 4.5 year bonds yielded 25 to 50 basis points. So here, on your point of our interest rate risk, here you can see Bank of England came in and said, we're going to buy even more of these bonds. And so the trade got even more inverted. The 4.5 year bonds yielded even more than the 5 year bonds. And now what happened eventually was Bank of England was buying so many gilts, they couldn't get all the gilts they wanted. We talked about, initially they said they'd buy 30% of the gilts, and then it got up to 60% of the gilts. They can't take in the gilts that they want. And so they're saying, hey, this idea of just buying longer than 5 years and shorter than 25 years, this is killing us. We need more gilts. And so they eventually changed their mind here and said, all right, we're going to buy everything that's longer than 3 years, all the way out, to the very longest part of the curve. So that, when they changed their mind and kind of threw in the towel on trying to be clever and just buy the very narrow portion of the curve, then you can see here, the curve normalizes and 5 year bonds yield more than 4.5 year bonds. And so that's how Barnegat makes money. That Barnegat goes in, we buy 4.5 year bonds that are around these high yields. We pay these 5 year yields that are low. And we have to wait. I mentioned that these trades take years to sort themselves out. And this is another example. This one worked out more quickly than most of our trades do. But so when the Bank of England changed their mind and said, we're just buying 5 year to 25 year and said, all right, we're going to switch to 3 year to as long as the curve goes, this curve normalized and we were able to make money on that.
So what would you say that's a butterfly and you make money out of just volatility, even if volatility apparently so when the ends at one point?
Sorry, can you say it again?
So you call this a butterfly at one point?
Yes.
And then you make money out of volatility, just a butterfly?
Yes, we can make money out of volatility, yes. So that is another kind of hidden benefit of this trade. So just what he's talking about is convexity. So just so you know, if you do, I didn't put that on this presentation, but if you do a math exercise, and let's say you have a 5% bond that goes for 5 years, or let's say a 5% bond that goes for 10 years, a 5% bond that goes for 20 years, and a 5% bond that goes for 30 years, if you are long, short, long on a dead flat curve, and yields go down or they go up, you make money both ways. So if you just do a discount rate and check the math, just change the discount rate from 5 to 4 and 5 to 6, you can see that that trade will make money if rates go down or if it goes up. So yes, that is a big part of Barnegat's trading and is a hidden benefit here. I guess I'm just trying to say this yield curve was so fantastic that That was a bonus, but this is even bigger bonus. But yes, you are correct. If you have a butterfly trade on a flat yield curve where all the interest rates are the same, and you receive the short one, pay the middle one, and receive the long one, you will make money whether rates go up or rates go down.
So you're edging yield duration in that case.
Correct. And so that's what we're doing here too. So our ratios are just long $1, short pound, long £1, short £2, long £1.
And at one point you lost money because the yield durations move and you're unhedged.
Yeah, so the way we lost money is that this low rate went even lower. Because Bank of England says, hey, we're gonna buy even more. And so the market just brings that interest rate. So, bonds, when the price goes up, the yield goes down. And so that is how we lost money initially. But as time passed, this worked out fantastically well.
So just on that, you also made another comment saying that you weren't particularly good at timing the near term. How do you manage that liquidity risk if you're using this type of strategy? Like how much do you have a policy, I guess, from a corporate standpoint, of we have to have this much as a cushion in case the margin calls come in?
Yeah, so that's a big point. So let me start with, everyone wants us to have a policy, Barnegat does not. And so just background, we get a lot of phone calls because we're the top performing fund. There's 30,000 fixed income funds on Bloomberg. We're the #1 fund for the last 25 years. So we get a lot of phone calls saying, oh, hey, I'm interested in Barnegat. And I give them this sheet of paper. Here's the 9 reasons you don't want to invest in Barnegat. And that's one of the issues that people want to hear, oh, if you lose $1 million, you're going to cut the trade, that kind of thing. Barnegat does not have that policy. That's one of the items on our list of why you don't want to invest in Barnegat. We don't have stop losses. We have invoked stop losses, but at the beginning of the trade, there's nothing set in stone. Because the thing that happens, or let's sorry. So let's just say on the gilts versus linkers. So right here, linkers yield a lot more than gilts. So one of the things, we get into the trade, let's say we agree to receive like 1% more on our linker than we short on our gilt. And then it goes to 1.5%. We have to post we have to post collateral with the counterparty because we have lost money. We said, hey, we're willing to do this trade at 1% different. It goes to 1.5% different. And the counterparty says, all right, you owe us $1 million because you're down on that trade. So that is a super important part of trading. So I think I have that on one of these pages. Yeah, so this is to your point of why doesn't everyone do this? And one of the big things is we're doing the same kind of thing as long-term capital. Everyone, rips long-term capital for being a bunch of dopes. Every one of those fixed income trades made money. That's how Barnegat began. Barnegat began, so just to give you a life story, I was living in London. I lived in London 98, 99, 2000. And I was working for a fund, and long-term capital goes bust in the fall of 98. And in my mind, I thought, oh, this is the greatest thing ever. They go bust, they drive all of these mispricings crazy. Even way more mispriced than the stuff I showed. It was fantastic. And so I have these presentations just like this one. I would go to investors and say, hey, I have fantastic opportunities. Here's the trades. You should invest in my fund. And nobody wants to touch it. I went for 2, because we're doing the same kind of thing as long-term capital. One of the things people said to me is, how many Nobel Prize winners do you have? I said, well, I don't have any. And they would point out, well, those guys just went bankrupt with 2 Nobel Prize winners, and they lost all $4 billion. And so nobody wanted to touch fixed income arbitrage. So for 2 years, I was living in London. I was traveling back and forth from New York to London trying to raise money for the fund. And I put my own money in the fund, and it worked great, made a bunch of money. I didn't have any other investors. I was living in a friend's walk-in closet. And I would walk to, Bloomberg is kind of the source of any pricing you want. I would walk to the library, and there would be a line at the library of all these people like me who wanted to use the Bloomberg. The library had a couple Bloombergs. And I would go in there, you gotta write your name down. If you're not the first one there, you gotta wait a couple hours. I would write down all the prices at the time. The internet wasn't as great as it is now. Write down all the prices, walk back home, enter all the prices into the computer. And that is how I got Barnegat started. 2 years of nothing. No income, living in a walk-in closet, nothing. Now, one thing I was lucky, I was a bachelor, so I didn't have any costs. I drove my costs to zero. I put all the money in the fund. But just on the theme of, you think, oh, everything, goes the right way. It doesn't. Like 2 years of zero. And then finally, I got 3 investors. January 2nd, 2001, the fund began. I had 3 investors put in a total of 25 million. And so from there, we had great returns. You can see things went really well from the beginning.
Is it frozen?
Maybe. Oh, sorry, there it was. But there. So you can see the share price, we started at $1 and now we're at like $18.50. So it's going great, and it started out really well right from the beginning, but boy, was it tough to get started. Oh, and then so just on your question of, so the big thing with fixed income arbitrage is, can you hold the position? And so long-term capital, they were right on every single fixed income arbitrage position, but they didn't have enough collateral to hold the trades. And so on your question, Barnegat traditionally holds about 50% of the fund as excess collateral. So that, our worst year was 2008, which, we lost money on a variety of trades, but the gilt versus linker trade is an example, the UK yield curve, both of those lost money initially. We lost 37% in 2008, and it was brutal. It was like, Barnegat's my baby, and it's everything to me, and it was in trouble. But having 50% of the fund as excess collateral, 50% is bigger than 37%, so we just meet all the margin calls. We hold those trades, and we were up over 100% on the exact same trades. We didn't unwind them on the exact same trades. We were up over 100% in 2009. So just one other funny anecdote. Not quite. So a French insurance company calls us in, like right here, like 2007. We've had a great run. We're making a ton of money, no down years, everything's perfect. French insurance company calls and says, hey, I'd like to invest. Now, when we have less opportunities, we'll close the fund and we'll just say to people, hey, not right now, we don't have as much to do with your money. French insurance company yells at me for a half hour straight. Why don't you let us in? Just he lets me have it. And I was like, you just don't have any place to put your money. Just hold on. I'm sure there'll be a moment in the future where you can invest. And then so here, the share price tanks. It went from like above $2 to well below $2, and it was rough. It was kind of $2.50 down to $1.50. We're down like 40%. And I call him and I say, hey, we've got great opportunities now, and do you want to invest? And he says, no, I'm too scared, which is fine. He has the right to say that. It's fine. So I said, hey, here's your chance. And one thing I'm very proud of in Barnegat is I went to investors in the French insurance company, and I told them here, I was like, hey, we have great opportunities. Now, the one thing, I did say that in the spring of 2009 to them, like when the share price was here, little did I know that it would get the opportunities would get a whole lot better. Our share price would go a whole lot lower in the fall of 2009. So again, on that theme of Barnegat's not good at the short term, I told investors it was a great time in the spring of 2009. Our share price at that time was around $2.50. Now our share price is $18.50, so that was true, except the problem was it went through $1.50, before it got going again. But so I'll come to your question, but let me finish this anecdote. So here I call the French insurance company, and then FT. There's another trade that Barnegat was written up for in the FT. It was super nice. Every day of the week, 5 days in a row in 2009, they wrote articles about Barnegat, how Barnegat had made a fortune from the global financial crisis. And it was on this TIPS versus Treasury trade, which is the exact same thing as linkers versus gilts in the UK. The US had the same problem. So 5 days in a row, super nice article, it was great. And the French insurance company reads the FT, reads those articles, and calls and says, hey, I'm ready to invest. And I said, we're not letting you in. Like, we need people who are in for the long haul. That's the big thing. You need people who invest when the share price goes down and redeem when the share price goes up. Conversely, when the share price goes up, that means we had a mispricing like this, we made a whole bunch of money, now it's not mispriced, so we don't have as much to offer. So that's what we're looking for in investors, which is very tough to find.
Yeah, just one question. Did you ever, over the 25 years, use leverage? Because obviously that was a big thing with L.T.C.M, that they were so over leveraged.
Yes.
You know, just like, I don't know, a few percent movement kind of wiped out the fund, right?
Yes, so we definitely use leverage. So let me start with, I guess one of the questions I would say that's a little tricky on measuring leverage, if we do a derivative, the derivative costs 0 on day 1. So you know, if you add up all the notional of our trades, even though they cost 0, that leverage is like 10 to 1. So just to be clear, we have plenty of leverage. You know, on the point I raised earlier, when people are interested in Barnegat, I send them that sheet of here's the 9 reasons you don't want to invest in Barnegat. We have plenty of leverage, and people don't like that. So just I tell everybody up front, hey, we got plenty of leverage. We got all these things that you're not going to like. And it has kind of worked well in a backwards way, as in most investors, you know, we get a ton of calls. I'm going to say 90 to 95% of those investors that call, and I hand them that sheet, they're like, all right, it's not for me, which is fine. It filters out those people. And another note is Barnegat only has 65 investors. Like, we're the #1 out of 30,000, but we don't have that many investors because most people do get scared by the leverage. They get scared by no stop loss. And you know, we're doing the same kind of thing as long term. So people hear that and they're just like, ah, it's not for me, which is fine. And so kind of the people who are left interested are the ones who really understand fixed income, which makes for a great investor.
So what's the gross leverage?
But like 10 to 1. So I'm saying if you add up all of our trades, and it doesn't matter if it's hedged, no excuses, no nothing. Just add up all those notionals, that number is about 10 to 1.
And how do you get to a net exposure?
Well, our net exposure is really just 1-to-1s, because so I think of Barnegat as 2 funds in 1. So the fund is like 560 million. We take that 560 million, we buy collateral, kind of like a mutual fund. Is that an American word, or the English call it a mutual fund?
We have.
Okay, so we just have 560 million. We buy 560 million worth of government bonds, so like T-bills or Gilts or whatever it is, anything that the counterparty will accept as collateral. So that's about 20% of our risk. So I think of that as just an old-fashioned mutual fund, no leverage, no nothing. We just have 560 million, we buy 560 million worth of stuff, and we post that with the exchange as collateral. Then about 80% of the risk is our hedge fund. So all these trades that I'm going through are the hedge fund style trades, like long linkers, short gilts, yield curve butterfly. Those are all kind of what I call the hedge fund trades. Though that net is 0, because you know, like here, you asked about the net leverage. Net leverage on this is 0 because we're long 1, short 2, long 1. So we are not making any bets on rates going up, the whole yield curve going up, or the whole yield curve going down. We're just making bets on this yield is too low relative to this yield and this yield. So does that make sense?
Yeah.
Okay, so we have, in the hedge fund side, we have as many longs as we have shorts. So that nets to 0. But if you add them together, it's kind of like we have 5 times our AUM in longs, 5 times our AUM in shorts. And then on the mutual fund side, we just have 560 million. We own 560 million, so it's just 1-to-1. So net comes out to 1-to-1. Gross comes out to about 10 or 11-to-1. Any other questions, or I keep going?
I think as you mentioned that collateral, excess collateral uncapping is very important. So I think how do you decide the 50% as a number of 50%?
Yeah, so that's tricky. I don't have a great explanation as to 50 being a magic number. So one of the things here I talk about, here you can see our volatility is we aim for the volatility of our share price to be 8 to 10% a year. And so I thought, hey, if we have 50% collateral and an annual volatility of 8 to 10%, so that's saying 5 to 6 annual standard deviations for us to blow through our collateral. I thought that was enough. Now, to be honest, I never thought we could lose 37%, but we did lose 37% in 2008. So I thought 50 would be more than enough cushion, and it did. I mean, it was more than 37% loss that we had, but to be honest, I didn't think we could lose that much. Like 2008 really was something. So I guess just kind of looking at the volatility, another thing on that excess collateral, the volatility of the fund is very important. you know, the thing that got long-term capital is they were right on all the trades, but their share price is flying around so much, it's got so volatile that it hits zero, and then when it hits zero, the game is over, you're just out of money. And so that's what got long-term capital.
Do you only do government issued bonds?
Correct, yeah, so now just, we do derivatives, so interest rate swaps, those kind of things. But so derivatives on the government bonds, but yes, we only do government bonds, we don't do mortgages, we don't do corporate bonds. The countries we cover around the world are basically the developed market plus kind of 4 of the larger emerging markets. So we do US, Canada, Mexico in North America. We do all the countries in the Euro, plus Scandinavia, plus Switzerland, plus UK if you don't count that as part of the Euro anymore. And then plus we trade South Africa in that time zone. And then in the Far East, we do Japan, Australia, New Zealand, Korea. And so those are the countries, the government bonds that we cover. And sorry, Czech Republic and Poland were 2 new countries as well. Any more questions, or I'll keep going? Or so the risk of one of the things people say is, you know, how do these things, they're so obvious, how do they get out of line? And remember, when you put on a trade, you have to post collateral, even, like, let's say the trade's gonna settle in a year. If you're down today, you lose $1 million today, you have to send the counterparty $1 million every single day, and if you make $1 million, they send you $1 million. So every single day, you have to post collateral with the counterparty if you lost money, or they'll send you money if you made money. So even if you go to them and say, hey, I own this blinker and I'm short this gilt, and we know it's gonna make money in 5 years, it doesn't matter, they don't care. Every single day, you have to settle up on whether you made or lost money. And then, you know, I highlighted here, we frequently do lose money, and that, you know, the 2 trades that I showed, the linkers versus gilts, we lost money on that initially, and the yield curve trade, when Bank of England came in and said we're going to do even more intervention, we lost money on that one initially as well. Another big thing, you know, I mentioned how I send people that note of, oh, here's all the bad stuff about Barnegat. If investors bail out, so in 2008, we were down 37%. If they say, all right, I want to redeem, I can't take the pain anymore, then it's over. So one thing I'm very proud of is that investors put money in 2008. So that was super important to Barnegat. And then same thing, like your counterparties have to be comfortable to trade with you, because if you don't have anyone to trade with, then, you know, the whole thing goes awry as well. So there's a lot of, you know, things go awry before you lose 100% of the money. Like investors will start redeeming, or counterparties will not want to trade with you. There's plenty of other ways for things to go wrong. Oh, you know, one other interesting thing, just on how these things happen. This is my graph on it's human nature to buy high and sell low. Like everybody thinks, oh, it's so easy. I'll just, you know, when they're mispriced, I'll buy them, and when they're efficiently priced, I'll sell them. But just humans don't work that way. So this is, I'm pretty sure this is from Wall Street Journal or Financial Times, but this is on mutual funds. You know exactly the performance of the mutual fund. It's public information. They just have a share price. But you also know the inflows and outflows into a mutual fund. So mutual funds, even though they're clicking right along, they will have bigger AUM and smaller AUM as investors add to their investment or redeem from their investment. So looking at every single kind of, you know, fixed income, emerging markets, stocks, large cap, small cap, value, like you would think, oh, maybe value investors are buying low and selling high. They're the worst. They, look at this, the loss between what the fund produced, we know what the fund produced, and what the investors received, they burned 1.46% a year in the high volatility funds. They burned about 0.5% a year in the low volatility funds. But here's another extreme, but every single one of these is the investors are buying high and selling low. So I know, like, you think, oh, any idiot can do this, which is true, but the tough part is when the world's falling apart that you don't sell low and end up buying high. And so clearly the world does that, every single kind of investment method. But here's another extreme example of, this is ARK. do you know, ARC is the mutual fund that it's, your name's Kathy Wood?
Yeah.
And so her big thing, she said, I'm a disruptive investor. I'm just gonna invest in disruptive companies. And obviously that was a home run when venture capital was on fire. So you can see, look at her returns here. So here, this is before venture capital catches fire. You know, it's kind of unchanged. Look at the assets she had, 7 million, 9 million. Then it starts to catch fire and assets go, you know, up to 116, up over $1 billion. Then she has another big year, and then she has a whopping year. Remember, COVID was 2020. Biden and the government puts a ton of money into the economy. Stock market takes off, and so does Tesla. She was a huge Tesla investor. So look at, these are the returns that her fund produced. And look at what her investors earned. So here, this is the average 1-year investment. But in the end here, this is the total thing. Her fund had a rate of return of almost 10% a year. Her investors had a rate of return of negative 25% a year. Because they all, you can see, like when things started to go awry in 2021, 2022, you can see her AUM came way down. People started redeeming. So it's human nature to buy high and sell low. And that's what will eat you alive. But that's just, you know, how it works. I guess, you know, one interesting thing on another investing theme, I met Andrew. He had worked for AHL, the big man fund. And AHL is a futures momentum fund. And when they told me, so just as a side note, Man was interested in Barnegat because we're negatively correlated to their big product, AHL. And so when they told me, I said, oh, what does AHL do? And they said, we're a futures momentum fund. When the share price is going, when the stock or the future or whatever it is going up, we buy. And when the thing's going down, we short it. And I was like, boy, that sounds like a recipe for trouble to me, because you're just buying high and selling low. But they have made a lot of money because they try and get in and start shorting before everyone bails out. And their investment idea is, oh, when share price is going down, people are gonna panic. So if I sell now, and then everyone panics, I can buy back at a much lower price, or vice versa. Like when Tesla is going to the moon, like right here, you know, Kathy Wood was long a ton of Tesla. When that share price goes up, everybody's gonna pile into that. I'm gonna buy it now, everybody's gonna pile in, and then I can sell it at a higher price. And AHL has made a lot of money with that type of strategy, just, you know, effectively monetizing that it's human nature to buy high and sell low. I think, so if you want to go over a trade where I lost money, this is the biggest mistake of Barnegat's 25-year history. Just to go over this, you know, interest rates are usually higher than inflation, and they're usually around the GDP growth rate of your economy. And so that kind of makes sense. So let's say that if interest rates are way above the GDP growth rate of your economy, you just own bonds and you get wealthier because you're growing faster than everybody else. Let's say if interest rates are below the growth rate of your economy, that's basically private equity. What is private equity? They're really borrowing money below the growth rate of the economy. They did fantastic during quantitative easing, and they're investing in the economy. And so that's kind of private equity in one sentence. They're just borrowing below the growth rate of the economy and then investing in the economy. So the net point of all that is interest rates over the long haul are kind of the growth rate of your economy, because there's two forces kind of keeping it there. So here you can see in England, interest rates are well above the inflation rate for 30 years. That all makes sense. Here's the difference between the two. You know, and the England grows kind of 1 to 2% a year, so that makes sense. Then quantitative easing begins, like right here, and Bank of England's buying all the bonds they can. They force the interest rates down, and I thought, who in the world's going to buy a 30-year bond that yields 3%, like you can see here, 3% for 30 years less than inflation? So that means a pension fund is going to lose 50% of their money because their liabilities go up with inflation. Their assets are in the interest rates, and those rates are 3% below inflation. I thought nobody would do that, but just with Bank of England buying it, it just kept going and going. And so Barnegat, we got this trade wrong, because I thought nobody's going to invest in interest rates below inflation. I got it wrong, and then we bailed out of half the trade here, so I was the idiot buying high and selling low. And then sure enough, Liz Truss comes in and says, I'm going to do unfunded spending, and the market normalizes, and you can see rates shot up. So we only made money on half the trade. We locked in losses on half of it. So even to me, who I remind myself every day to buy low and sell high, even I fell into that trap. This is Barnegat's greatest mistake in the 25 years.
What is your decision making? Like, because you said, you have to, let's say keep the trade open, because at the end of the day, you will, like, they make money, right? But then at some point, you lose so much money and your collateral kind of burns through, and you kind of, then exit the trade. Is there do you have like a certain point where is that really trade by trade?
We have had stop losses, and this being an example. So look at how long this was. We get into this trade when the yields were the same, so that's 2010. I threw in the towel like 11 years later. That's how long I was waiting. It was killing me, 11 years of losing money. Now the one thing I'd say, we have 15 to 20 of these trades around the world, these kind of messed up pricings. So usually in a perfect situation, a bunch of them are making money. We have a loser. We can add to the loser because now it's more mispriced. In 2008, we had some stop losses as well because we were down 37%. So there's no magic formula. The general idea, as things get more mispriced, we're going to put more on. As they're less mispriced, we're going to take them off. But there is no magic formula. And so, this being an example, if I threw in the towel at the worst possible moment, interest rates 3% below inflation, and that hurt. Any other? I think this is the last. Yeah, that's the last page. Any other? I'm happy to answer any questions or life stories or anything.
So, sorry, you can know you go. Watch out.
Congratulations on everybody. Really interesting. But how did you convince investors to give you that first 25 million no trap?
Yeah. Well, no, I was at other funds, so I worked at 3 other companies. That's one other thing too, I would say, just on, I guess, life stories. Working at a place that is good and has talented people is so much more valuable. And one thing I would say to all like graduates or students, don't make the decision on how much money that opening job is. That was worth so much less than what you'll learn. So I was super lucky. My first job was a place called O'Connor, which was an options market making house that did FX. Eventually they were taken over by Swiss Bank. Super successful, super talented. It was a fantastic place to start. Then I went to, my college roommate was a math major. He called me and said, what's fixed income arbitrage? I told him, and he's like, and he was 1 year younger than me. He was just coming out, and he says, oh, I don't want to do fixed income arbitrage. I was like, oh, I would love that. Can you give me that interview? He's like, sure, here's the interview. And I got that job. I worked for a fantastic company through the 90s, learning a ton. Like, they were super talented. We were making money hand over fist. It was great. And then the third company I went to had known how well my second job, how much money they had made. But then long-term blew up. And I made, and this was completely wrong, in 1998, long-term blows up. I thought, oh, I can go out to people and show, I can show them trades like this, insane yokers. I was like, I can just show these people this, and they're going to trip over themselves just trying to race into my fund. And that was not the case. So it was very hard. I didn't have a track record per se like the share price I have now, but I did have 3 jobs of trading where I wasn't the guy running the show, but I was helping, come up with trade ideas and that kind of thing. So I didn't have a track record, which makes it very difficult. So I mentioned the 2 years of struggle where I was living in the walk-in closet. I was reading the newspaper every day, reading Bloomberg every day. Anytime there would be some story of this rich person just sold their company and now they're creating a family office, bam, I would hit them with a snail mail. And it was tough. Like, even now, today, we're number 1 out of 30,000, and 95% of the people who call me say, it's not for me, I'm not interested. And so, even now, it's tough. And I'd say, the fundraising, particularly the first dollar, that is the toughest part. And, I'm super grateful to those 3 groups that took a chance on me when no one else will. Just one other anecdote. I don't know if these anecdotes helped, but there was this guy, Alan DeCoster. I still remember this meeting. So he's a big investor. At the time, he works at Credit Suisse, big investor. And I go in, I do my pitch, and I tell him about kind of the two funds in one. There's the mutual fund and then the hedge fund, and he just turns to me and he says, that'll never work. And that was before I got going. That was during the 2 years of living in the walk-in closet, and that was crushing. And because he worked at a huge fund of funds, and he's like, that'll never work. And sure enough, we're still going. He's out of business. So I know that's a little nasty, but that, you know, you have those moments, like, it is tough.
How has your investment process evolved over time? You mentioned sort of having to walk to the library and sort of take notes from Bloomberg and put them into.
Yeah, so now we have our own Bloomberg.
And I guess have you had to adapt your investment
I would
process?
say not much. The one thing I would say to that is we have a little bit less leverage. You know, I mentioned that I didn't think we would lose 37%, and we did. And so from that, I was like, maybe our leverage is a little too high. So it's not a grand change. It's not it's a little bit less. And then trading-wise, it's all the same thing. The names change. So like, this happened in the UK, and like, this is what the FT wrote those articles about that 1 week. This is tips versus treasuries. So here you can see they're efficiently priced for years. Lehman goes bust. Lehman held a lot of tips. The yield difference goes through the roof. So you can see everybody wants to own treasuries. When there's a crisis, everybody's like, hey, treasuries are the safe place to be. So the blue line here is the yield on treasuries. That plunges as everyone wants to own the safe stuff. Now tips, once you hedge out inflation, they are a treasury, but people don't care. And so the yield on tips goes up. So this red line is the difference between the two. And so the names change. So whether it's this time it's the US, Japan's kind of got an interesting situation going now where they've had 0% rates for like 30 years. They're so used to zero that when they don't have zero, things get a little weird. So the names change, the countries change, but the principles are the same of trying to, hey, has the same maturity, same credit, same everything, but different yields. That's right up our alley. Or some yield curve getting distorted, that's right up our alley.
Thanks for the presentation. And my question is that to what extent do you think your experience in fixed income trading can be transferred to another financial asset?
To what was the last part?
To transfer to another financial asset.
Well, I would say probably not so well. So my stock trading is okay. It's nothing. So did I just do personally? I have to invest my money somewhere. My stock trading has not been that great. One of the things I think I was a math guy and I like market psychology and that kind of thing. The thing that's great about fixed income is if I can buy a bond that yields 5 and short a bond that has same credit, same government, same everything, it yields 3, you get paid a 5% coupon. So that's one important point. So let's say I buy, like here in this example, here, let's say you can see the yield got up to 5% on the tips, and let's say the treasury at the time was 2.5%. If I buy a tips that yields 5, shorter treasury that yields 2.5, if I come back a year from now and the yields are still 5 versus 2.5, you think, well, that hasn't done anything. But actually, I've made a bunch of money because I took in 5 for the year and I paid out the 2.5 where I'm short for the year. So I've made 2.5%, and remember the trade cost 0 on day 1. So even if the mispricing remains mispriced, and that does happen. We have a trade that we've had on the life of Barnegat in Japan, and it's still just as mispriced as it used to be. And we've made over $100 million, and it just remains mispriced. But we just keep clipping the coupons every year. Like the mispricing just remains. We receive the high one, pay the low one, just keep clipping that coupon. So that's the beauty to me of fixed income arbitrage. That even if it doesn't correct, even if it stays mispriced, we can make money. Whereas stocks, let's say you're, long Volvo and short Volkswagen or something like that. Different things can happen with those companies. Or, like the guy who was running Renault gets arrested in Japan, and, there's individual stocks have a whole bunch of circus that can happen. Whereas fixed income arbitrage, that you have the same government, same maturity. I find that more comforting.
One question. How much of identifying these opportunities is automated? Because I can imagine that, as a grand factor of these very elaborate models, and they, trade quite directly on things without even looking at the matter sometimes. Is that an issue for you, or is that like the manual part?
So, of the things Barnegat's good at, we're very good at IT. We have fantastic IT, fantastic analysis. But in the end, I mentioned like AHL, where they have that futures momentum fund. That is just a computer saying, oh, it's up 3 days in a row, let's buy it. I don't want to oversimplify their stuff, but that theme of computers making the decision. Whereas Barnegat, we have a lot of analysis, but in the end, it's a human making the decision. So IT is super important. We have fantastic IT, and they produce great analysis, but in the end, a human has to say, okay, I want to put that trade on.
Thank you for the presentation, sir. Is there any risk metric that's or signals that you will be monitoring, there will be central banks who comes to in this treasuries policies and there's mispricings, but you never knew exactly is that high enough or low enough to buy and sell. So if there is any monitoring of signals to.
Yeah. So that's a tough part. When is, just to give you on this trade here, we entered the trade right here. We received 1.25% more on our tips than we shorted on our treasuries. I thought it was the greatest thing I'd ever seen. And little did I know, it went to 2.5% mispriced. So on the things that Barnegat's not good at, Barnegat's not good at saying, oh, this is the moment, or when the central bank steps back, or those kind of things. We're not so great at saying it's not going to get any worse from here. We get run over plenty of times, and that's why having the excess collateral is so important, and having the stable investors is so important. So I wish I could say to you that oh, I'm a wizard at spotting these moments, but the reality is we lose money at least 50% of the time getting run over on a mispricing. Like here, it's more mispriced here. So I wish that wasn't the case, but that we're not so great at that.
But then you double down.
Yes. So the important part to remember is, so here, even though these trades lost a whole lot of money, in the end they made money, because then the market 3 years later, and that was one other point, we talked about these, you think these things correct very quickly. Tips versus treasuries took 3 years. So this is Lehman goes bust, the autumn of 2008, and this doesn't correct till autumn of 2011. So that's 3 years. US government bond market, the biggest, most efficient market on earth, took 3 years to correct. So yes, we added to the trade as it got more mispriced from here. And we took a beating initially. Like I said, we lost 37% in 2008.
Are you allowed to gate the fund? Gates the fund.
Technically we can, yes. But so the thing I would say there is, you can do that, but I think, how I say investors are so important to Barnegat. Long-term investors, like I told that French insurance company, no, I'm not letting you invest, because that's not the kind of investor we want. So I think it's a two-way street. That I am super appreciative of those 3 people who took a chance on Barnegat in 2001, and all the investors have come in since then. I mentioned we lost 37% in 2008. Investors put more money in, so we have great investors. I think if I gate the fund, yes, legally I can do that, but I think it's a two-way street. Like if you start screwing them, all the goodwill is gone. So I don't think that might work for a minute, but once you do that, you're kind of close. And the other thing too, just in reality, once you gate the fund, everyone puts in their redemption, so they're all kind of on the same pace, and so things are kind of done.
So in 2008, how did you get your investors to invest more rather than grow?
Yeah, so just so you know, these are all presentations. So once a month, I send presentation to the investor, and my logic to that is, so I send them, this is a presentation that I send to the investors. My logic is, hey, if they understand more about our trades, and we lose, it's this mispriced, and it becomes this mispriced, my hope is that I have showed them enough, I've been transparent enough that they say, oh, it was this mispriced, now it's this mispriced, I would like more of that investment. There's nothing etched in stone, they don't have to. You know how the private equity guys have that right to call money from investors? I don't do that to anyone. So everyone, you can do whatever you want, you can redeem, you can invest. So it's a tricky, I think again, it's kind of like on his question, it's a tricky balancing act of trust. As in, I'm trying to be transparent, I tell them all the details of the trades, and we do one trade a month, we go over it in detail, and my hope is that when we lose money, we've lost money twice in 25 years, that they understand that trade and say, oh, I would like more of that trade. That's my hope.
But theoretically, they all could have withdrawn at the same time.
Yes.
As well.
Yeah, and so we were, on our 2008 trades, we lost 37%. The next year, I think it was, it was something like 125% the next year.
It was 125.
Okay, yeah. So we made a ton of money the next year. So we were right on every, just like long term, we were right on every single trade. But had they redeemed, the point would have been moved. The fund would have closed because everyone redeems. And so it's a very tricky balancing act, and there's nothing etched in stone. I think that's one of the reasons, my list of bad stuff about Barnegat has kind of worked in a backwards way, in the sense of the only people who read that and invest really understand fixed income, and then when it goes haywire, they're like, oh, I would like more of that. So it's kind of filtered out, like the French insurance company who's had its chance to invest at $1.50, and now it's $18.50. It kind of self-selects. So that's been one kind of hidden benefit that I didn't anticipate. I was mostly just trying to save myself time. I was like, I'll just tell you all the bad stuff now and skip the whole back and forth.
Looking at the current situation in the US, people getting worried about the bond market, and I think just yesterday there was news about like a little demand for the 20-year treasury. What's the opportunity there right now?
Well, so that was this month's presentation to investors. We have on a US swap spread trade that is an interest rate swap against a US government bond. That is mispriced. But if the US government defaults, then that trade loses money because we own the US government bond. So that is a risk to Barnegat. And that's a tricky one. Like one of the Trump's great quotes is, I love debt and I love defaulting on debt. Like, if he defaults on the US debt, Barnegat is in a jam. And so, because our collateral, that $560 million, a bunch of that is in US government bonds, just as collateral that we post to the counterparty. So I think the world has bigger problems than Barnegat if the US defaults on their debt. But Western worlds, the presentation that I wrote, one of the big risks of Barnegat is can pay, won't pay. And so we have government bonds in the US, Australia, Japan, and UK. All of those have a printing press, so they could all pay off their bonds anytime they wanted if they control the printing press. The question is, like Russia had a situation where they had their own printing press, and they said, nope, we're not paying anymore. So it has happened of can pay, we have the printing press, we have the money, we're not going to give it to you. That is troublesome for Barnegat, and I do worry about it, and I don't know the solution to that. Because let's say, whether it's Biden was spending money like crazy, running a huge deficit. Trump is putting in tax cuts, and let's say keeps the spending similar. Both of them end up in a huge deficit. It's amazing. The U.S. deficit now is 7%, with inflation, unemployment at 4%. To have a deficit of 7% is unbelievable. And so that does worry me. It can't go on forever, and things that can't go on forever don't. So that is worrisome to me. I don't have a great answer. Did you have one?
So I have two more questions unless someone else wants to go. My first one is you've got some risk metrics about your volatility and stuff, but my question is do you actually care about that?
Yes, so that is huge. So the big things that I care about, I actually don't care much about leverage. There's all sorts of tricks you can do with leverage. Banks will offer you all sorts of products to make your leverage look less, so you can go to investors. So leverage, I don't really care about leverage. The things I care about is the volatility of the fund. So remember, just long term, all the trades were winners, but the thing gets so volatile, it hits zero, and the game is over when it hits zero. Remember, you have to post the margin to the counterparty every single day if you're losing money. So volatility is super important. We aim for 8 to 10% over the long haul. Our fund has been around that for the 25 years. The other thing that is very important on that same theme is, I mentioned we have 15 to 20 trades around the world, all similar to this. You know, the names change, but the principles are the same. And we're looking for trades that are uncorrelated, or the perfect world is they're negatively correlated to each other, so that when one's making money, the others lose. I mean, we don't want one to lose money, but that hopefully when one loses, there's a bunch of other ones making, that they're not all subject to the same risk. So I'd say that is a huge volatility, and correlations are a huge deal to us. Like one of the things that happened in April, you know, Trump had his Liberation Day, and the market got very, you know, stock market went down a ton, bonds went down in price, up in yield. The market got very scared. There was kind of a liquidity event there in the middle of April, and Barnegat lost money. And one of the things that was a sign of trouble is our trades started becoming correlated, which is a sign that other hedge funds also have similar trades on and are starting to take them off because they're losing money and they're getting these stop losses, and so Barnegat's trades lose money as well. So that is super important to us.
But something that's really, I think you've highlighted throughout the presentation, is the risks of the investments. But the difference is the risks you're talking about are largely known. So I'm thinking, are there actually any risks in the trades that you really sort of can't foresee? Because I think the benefit of this type of strategy is that when you actually do take risks, you're one of the few people that actually know what the
I think, you know, on the other question on like bonds versus stocks, does our stuff apply?
Exactly.
So I think that's why I like the bonds, because boy, if we're short one government bond, we're long one government bond, all those features net out against each other. So let's say on like linkers versus gilts, let's say the UK government says, all right, they're all worth 0. We're still okay because we bought linkers, let's say at a price of 80. You know, I do yields up here, but let's say I get prices. The price of linkers were like 80, the price of gilts were 100. If they both go to 0, we're still happy because we shorted at 100, bought at 80, they're both at 0. We're okay. So that's why I like bonds. I think that is a benefit of fixed income arbitrage. You know, the things people hate about it is, oh, we've got a lot of leverage because we're long bonds, short bonds, there's a lot of that going on. And then you asked about the unknown risk. I guess on his point of, you know, what about governments and default and that kind of thing. You know, I guess I know that risk, but it sure is a wild card. Like, you know, there's nobody running on austerity in basically any country now, and so that is like, how bad can it get? I guess that part's kind of unknown, but at least I guess it's a known unknown.
How large is your team?
Well, 6 people. So that's on the list of 9 things. Here's the 9 things you're not going to like about Barnegat, and one of the answers is 6 people. So, because one of the problems is sometimes I think I should hire a whole bunch of team to look like they're busy, so when investors come in, they think something's going on. The problem is, you know, this trade here, we put it on, you know, it gets mispriced, and it's years later that it gets efficiently priced. I mean, the TIPS versus Treasury was even longer. So, the TIPS Treasury, you know, that's the graph that took 3 years to sort itself out. Here you can see we got in at 1 1/4, so that's the autumn of 2008. You know, 3 years to start to go up. So we really don't do much. There's way more days with no trades at all, nothing, than there's days with trades. Like when Andrew joined us, I remember worrying that Andrew would think that we're not doing anything. Like, because he was working at AHL, they're trading all the time, they're doing 50 different things. Whereas Barnegat, there's a lot more days with no trades than there's days with trades. And I remember thinking when he started, I was like, oh man, this is gonna be weird. Like, you know, the first 2 weeks we didn't do anything. So that's a unique part of, oh, and on the question of how many people, there's only 6 of us. So investors don't like that. You know, they come in, our office is kind of a dump, and they just come in and they're like, what the hell's going on here? That's another difficult part.
I guess we've got time for one final question.
So I'm very curious about your understanding about the UM or the size of the fund. Have you guys a fixed income fund naturally have a larger capacity than many other asset class, like the Bridgewater vehicles?
Yep.
After the UM based on fund?
Yeah, so So that's another thing that people don't like so much, that, why aren't you bigger, being number one, all that. So of the things we're weak at the marketing. I mentioned there's only 6 of us. There's a whole slew of reasons people don't like us. And I guess the other big thing is we don't have a marketer. There's only 6 of us there. None of them are a marketer. I don't enjoy that. Of the things, like I live a super simple life. I bicycle to work. Of the things that make me happy, I enjoy sitting there looking at these mispricings. That's what makes me happy. And I don't like bossing people around, so I don't want a big team, that comes with a big AUM. I don't want to spend my days talking to investors. I mentioned we only have 65 investors. There's not many of them. And half of our investors have been with us since 2001, like the whole way. So, and then on another selfish level, the employees are the biggest investor in the fund. So, on that selfish level, I don't want to dilute ourselves because we're the biggest investor. So, I guess that's more of a lifestyle decision. I don't enjoy those other things. I don't enjoy marketing. I don't enjoy bossing people around. I like just sitting there reading my stuff. Like, I enjoy just sitting there reading the newspaper, learning about stuff.
Thanks so much for sharing.